Welcome to Chapter 8 on process costing. Process costing is a method used to cost products made in a very particular type of environment. These products are not separately identifiable until the point of separation. Examples of this could include the production of whisky and gin, where it's being produced through a continuous process and you're unable to identify the actual product until it's bottled at the end. Let's look and see how process costing could come up in your exam. So again, this chapter could appear in section A of your exam, and what you'll be expected to deal with is lots of different situations in relation to process costing. So you need to be able to deal with the situation of losses, gains, scrap and work in progress. However, please do note that losses and work in progress will not be examined in the same question. So each of those four areas can be examined separately, so losses, gains, scrap and work in progress, but losses and work in progress together will not be examined in the same question. Let's look at it in slightly more detail over the page on your summary diagram.
So in this chapter, we're going to start off by understanding the general principles surrounding process costing and thinking about the treatment of losses. And we'll start off with normal losses, and we'll think about when they've got a value and when they don't have a value, before moving on to abnormal losses or gains, and finally to deal with work in progress. And we need to know how to treat closing work in progress and opening work in progress, but recognising that the business might not have finished everything in stock by the end of the accounting period. Finally, then, we'll need to be able to deal with subsequent and previous processes as well, once we've understood all of the details of process costing. So before we worry about all of the different types of losses and work in progress, we first of all need to understand what we mean by process costing. Process costing then is basically defined as a type of costing method where we can't possibly identify separate units of production because they're manufactured in a continuous production process. So what we're going to do is use an average of the total costs of the processes for the period compared with the total output of that process. So the sort of processes then where we can use process costing, and you could be required to identify these in the exam, would be something like oil refining. So you won't be able to identify a particular litre of petrol or diesel from the refinery at any given time. Paper production as well, you can't identify what's going to become a particular piece of paper while it's all in the mulching process. Lots of different food and drinks are produced in very large quantity, and it's not until they're bottled or packaged at the end that we can identify them. And also chemicals, paint and other liquids. So what we're going to have then in our process is our inputs will go in. They could be material, labour and overheads. Something will happen to them in the process, be it stirring, mixing, refining, boiling. And then from that will come the good output. And that good output may well be bottled or packaged so that we can identify the individual products. The first formula that we need to learn then is our cost per unit. So our input costs divided by the number of units produced will give us a cost per unit. And that's in the most straightforward of scenarios. But we're just going to take that formula as we go through the chapter and adjust it for the different types of losses and work in progress that would occur. In process 1 then, we have 1,000 units of input of materials which cost $40,000. We've also chucked in labour for $50,000 and overheads of $20,000. So in total then we have got $110,000 of input costs, and we need to spread these out amongst our 1,000 units of output. So our cost per unit will be the 40,000 plus the 50,000 plus the 20,000 divided by 1,000 units. So every unit of output is going to have a value of $110 if we average all of the costs that we've put in. Now if we have a look at the solution presented down here, you can see that we've got the cost per unit calculation, which we've just explained, and what we call the flow of units is very simple here. What goes into process 1 is the same as what's coming out in terms of good output. On a T account then, we represent this as 1,000 units of input on the debit side and 1,000 units of output on the credit side. You'll notice here then in our process account that we've got two columns, and the one that we complete first is the one for units, because we need to make sure that our units balance on both sides, and then we can complete all of our input costs, which here are the raw material, the labour and the overheads, and then we can value our unit of good output at $110, so that's where our final 110,000 will come from. And you can see that our process count balances in terms of the flow of units, but it also balances in terms of the monetary value. And as I'm sure you know, it's very important with a T account that our debits equal our credits. It's quite likely though in a production process that we would expect to experience some losses from the process. So there might be some wastage or evaporation. It's not usual that everything that goes in will result in the saleable goods. So when we expect some loss, we call it the normal loss. And the total of our good output and our normal loss will be the value of the inputs. For worked example 2 then, we've got the same inputs and costs, but actually we now find out that normal losses account for 10% of input. So we're expecting then there to be a normal loss of 100 units. So we're putting in 1,000, 10% will be losses, and our good output is as expected at 900 units. So over here then on the credit side, we've got two entries to make up our 1,000, the normal loss, and those transfers into process 2 of 900 units. We have all of the same input costs, so the 110,000, but now we can see that our cost per unit formula is going to be 110,000 divided by 900 units. So the expected good output. Because the assumption is here that the losses are worthless. So the cost of producing each unit of good output has now risen to $122.22 per unit. And if we multiply the 122.22 by the 900 units, that will give us our $110,000 that we have up here. It is important that you start to follow these stages and do these calculations, because as we move through the chapter, we're going to start to value those losses. So it's not just going to be a case that the outputs will be the balancing number, as they have been so far. In fact, when our normal losses have a scrap value, we will actually use those to reduce the processing costs. So our cost per unit formula now becomes the input costs minus the scrap value of the normal loss. So it could be that you're able to generate revenue from selling your scrap, perhaps as seconds, or maybe to a wastage firm who are prepared to purchase those units. And then we need to divide that by the expected number of good output. In the last worked example then, the scrap value of the normal loss was 0, which is why we had our 110,000 divided by 900 units. There's lots of different ways that the normal loss can be calculated and presented, and you need to read the question very carefully to make sure that you're using the right approach. Often it will be the percentage of input, and that will be the percentage of new materials which are input. It might be the percentage of throughput, so that would be opening work in progress plus any materials added, less closing work in progress. It might be a percentage of good output, or it might be a percentage of total output. You just need to make sure that you're applying that key skill of reading the question carefully to pick out the right approach. What we're going to see now then is another extension to the worked examples we've been using so far, which is a value of all of the scrapped units of $20. So the normal loss then is worth $20 per unit, and we have 100 units. So the scrap value of our normal loss is $2,000, which means that our input costs are $108,000 divided by the 900 expected units of output to give us a cost per unit of $120. If we multiply that cost per unit of $120 by the 900 units, we get to the 108,000 as the value of the good output transferred to process 2. And what we have here then is the value of the normal loss, so that's 100 units at the $20 each. And then over here on the debit side, as before, we've got all of the same input costs. And we're noting then that our units still balance, are 1,000 units of input, 100 units of normal loss, and 900 units of good output. And also that our figures in the right-hand column balance too. Additionally then here we're going to complete a scrap account. In the scrap account then we're going to have the other side of the normal loss. So we had a credit in the process account, so it's got to be a debit in the scrap account. Now we've got an amount sitting in the scrap account, and what we need to do is we need to transfer that out of the scrap account, and that's going to come in the terms of cash for the 100 units of $2,000 from the scrap man. So the scrap account will be cleaned out at the end of the period. In the previous examples then, we have accepted that there might be a loss, but we have said that it's always going to be exactly as expected. Now in reality, losses may be more or less than expected. So we have our inputs into process 1, and we have our expected loss or our normal loss. Hopefully we'll get some good output as well, but we might have higher losses than we expected, or we might have lower losses than we expected. And these not expected losses and gains are known as abnormal losses. We're starting off then by looking at an abnormal loss, which, as the name suggests, is just additional spoilage than we expected. The difference is that because we weren't expecting it, we can't reduce our process costs for it, and so we have to value the abnormal loss at the same as a cost per good unit. And it's the company's misfortune, so any abnormal loss is taken as a hit to the income statement for that period under the assumption that it's a one-off. In example 4 then, worked example 4, we're going to see what happens when output is actually 880 rather than the 900 units that was expected. So we start off then by looking at our units calculation, and we've got our input of 1,000, good output of 880, and a normal loss of 100. Now you notice that in the scenario information we're not told about the abnormal loss, and you need to do this unit calculation so that you identify if there are any abnormal gains or losses, because you won't necessarily be told about them in the scenario. And the abnormal loss here is the balancing number, which is 20 units. So you'll notice that we have an additional line down here for the abnormal loss of 20. We do not increase or adjust ever the value of the normal loss. That always stays the same. Our cost per unit formula also stays the same as it did in the previous example, because it's our input costs less the scrap value of the normal loss divided by the expected number of units of output. But that $120 per unit is for the 880 units, but to make it balance, we also have to value the abnormal loss units at $120. Once we've completed our process account, we then need to complete the scrap accounts and the abnormal losses account. So as before, the normal losses then are going to go as a credit in process 1 and a debit in the scrap account. But we've also got those abnormal losses, and they need to go as a debit into the abnormal losses account. Now it's expected that we would be able to sell those abnormal losses for the same scrap value as the other losses. So we've got 20 units of scrap and we can sell them for $20 per unit. So that gives us our $400. What we need to do though is take it out of the abnormal gains and losses account and we put that into the scrap account. So we've now got 120 units to sell the scrap man for $2,400. But what you might have noticed is that the value associated with those scrap units in the abnormal losses account was $400, whereas the value associated with them in the process account was $2,400. The scrap man doesn't care that we were hoping that those would be good units. The value to him of a spoiled unit is still the same. And that's where we end up with this hit to the income statement of $2,000. So it's a debit to the income statement because it's an additional expense, or it's a reduction in profits because of the extra losses that were incurred. The opposite happens when we have an abnormal gain. This is when there is less normal loss than we're expected. It gets treated in the same way as an abnormal loss. We never adjust the normal loss. So what we're going to see is how we would account for the abnormal gain. But basically, we never adjust the normal loss. Instead, it's going to be a credit to the income statement because it's an additional benefit. It's more units than we were expecting that we can sell as good output. And the abnormal gain will be valued as if it were a good unit of output. In the same way that an abnormal loss was. And we can have a look at that now through worked example 5. In example 5, we've got the final version on a theme, which is this time the output to process 2 is actually 920 units rather than the 900 units that we expected. So in our flow of units then, we've got the normal loss of 100 and we've got the transfers to process 2 of 920. So that gives us a total of 1020. Now we only put 1,000 units of input into the process, so to get things to balance we need to put an abnormal gain, and that abnormal gain goes on the debit side, and the way you can remember that is because it's the adjustment necessary to make it balance. In the exam then, if there is an abnormal gain, the examiner isn't necessarily going to tell you. So we use this flow of units calculation to identify the abnormal gain. And you can do that either through the units in the T account or through the calculation beforehand. The cost per unit will be exactly the same because nothing's changed in terms of the normal loss. The normal loss is still valued at $20 per unit, and the transfers to process 2 are still valued at the same cost per good unit, which was $120. So that gives us our amount transferred to process 2 of $110,400. So we also need to remember to value our abnormal gain at $120, and that is going to be popped in on the debit side so that we have a total of $112,400 on both sides. We have to complete scrap accounts and abnormal gains accounts in the same way that we did before. The other side of the normal loss then will be 100 units at 2,000, because remember we never adjust the normal loss. But what we have got is an abnormal gain on the debit side, so that's going to be a credit on the abnormal gains account. The scrapman was expecting all of these units, so actually it's going to reduce the amount of scrap that we've got. So we have the 20 units that the scrapman was going to value at $20 each. So that reduces down the amount of scrap we have, and we end up with cash for the 80 units at $20 each. And we also end up this time with a credit to the profit and loss account or the income statement to reflect the good fortune, reflect the fact that losses weren't as high as we expected. So that would be a one-off or miscellaneous income. The worked examples in this chapter so far are designed to introduce you to the concepts and the principles of process costing. What we're going to look at in lecture example 1 is an example of the way that this theory could be tested for a 2-mark multiple choice question. So we have 2 different processes here, J and K, and we're given some information about the inputs and the outputs from those processes. You can see then that the inputs weren't the same as the outputs, but we need to identify whether or not there's been an abnormal gain or loss. What we know then is that we were expecting there to be some losses, so we expected that the output was going to be lower than the input, but what we need to see is whether the losses were as expected. So what we need to do then is some calculations so that we can answer the question. For process J then, our input was 85,000 units, and we were expecting there to be losses of 3%. So what that means then is that we're expecting that good output would be 97% of the inputs to the process. So we were expecting then that output would be 82,450. Actual output was 82,400. So what that means then is that we have got 50 units of output less than we were expecting. And so that is going to be an abnormal loss. So we already know that it's got to be C or D. Now we need to have a look at process K. We put 47,000 units of input in, and we're expecting 7% to be losses. So 93% would be expected to be good output. So we're expecting 43,710. We got 44,000, so we've got slightly more than we were expecting, and we've got an abnormal gain of 290. So the correct answer is going to be C. So even when the question doesn't ask for a numerical answer, calculations can often be helpful. Subsequent processes then are when the outputs from process 1 become the inputs into process 2. The costs in each process then will include the full cost of the materials from the previous processes. because items must be completely completed in one process before they can be transferred to another. A bit of terminology for you as well. Sometimes we'll see the phrase conversion costs, and that's when our labour and overhead costs have been grouped together. In example 2, the output from process 1 is actually made into the inputs to process 2. So we've got 920 units which become the inputs into process 2. We're told then that normal loss from process 2 is 10% of good output, i.e. the output from the process, and the output from the process is 900 units. We're also given some information about other inputs and asked to prepare a ledger account with this information. So the normal loss then is 10% of the good output, so that's 10% of 900 units, so that's going to be 90 units. So we need to think about including all of these unit values before we start assigning values. So we've got the inputs then from process 1, so they'll be debited to the process 2 account and credited to the process 1 account. And we've got 920 units. We've got the normal loss of 90 units, and it doesn't have a value, so that's quite easy to pop in. And then we've got the good output of 900 units. Now you can see that the total of the units on the credit side is 990, but the total on the debit side is 920. So we need to make that balance, and we'll do that with an abnormal gain for 70 units. So deal with the flow of units first, then we can start to pop in the values. So the value then of the input into the process for those 920 units was 110,400. And we're also told that there are extra materials of 20,600. And we've got conversion costs, so labour and overhead costs, of $35,000. At this point then, I always think it's a good idea to mark out what it is that you're missing and what you need to calculate so that you don't miss anything. So I need a value for my abnormal gain and a value for the good output. And I'm going to do that valuation via a cost per unit calculation. So the cost per unit is equal to the input cost, so the 110,400 plus the 20,600 for added materials and the 35,000 for conversion, minus the scrap value of the normal loss, which here is 0, divided by the number of units of good output expected. And that's the input units of 920 minus the expected normal loss. So the cost per unit is $200. And I can use that to value both my abnormal gain and also my good output. So the abnormal gain, then 70 units at $200 each, is $14,000. And my good output, 900 units at $200 each, is $180,000. So on the credit side, I've got $180,000. I just need to add up and make sure that I've got the same on the debit side. So that my T accounts balance. And if you wanted to work through this, you can work through the scrap account and the abnormal gains account, and those are included for you in the solutions to the lecture examples. You're not going to have to fill in a set of T accounts, but in a question you could have the information that we've got in scenario 2, and you could be asked for the value of any of those items. So you could be asked for the value of the abnormal gain, you could be asked for the value of the good output. The assumption we've made so far is that everything that we start gets finished by the end of the period. But in reality, it's likely that there'll be unfinished items at the end of the accounting period. The unfinished or partially complete is known as work in progress. And we need to know how to account for that work in progress. When we're valuing our work in progress, then we need to look at equivalent units, because we can't value something that's 50% complete as the same as something that is 100% complete. So we need to work out the equivalent whole units. Example 3 then is going to help us illustrate why the concept of equivalent units is so important. So we have a process there with input costs of $250 and 300 units of output. But at the end of the period, only 200 of those are finished, and the remaining 100 units are 50% complete as work in progress. If we use our usual cost per unit calculation in part A, we're looking at what the cost per unit would be. So remember, we're looking at the input costs divided by the number of units. So 250 divided by 300 is 0.83 per unit. So the value of the work in progress then in this case would be 100 units at 83 cents. So that would be $83. And the finished goods, we've got 200 units at 83 cents each. So that would be 167. And that comes back to our $250. It doesn't seem right though that something that is only half done is valued at the same as something which is completely finished. So instead we use the concept of equivalent units. If we think about equivalent units, well, we've got 200 finished units and we've got 100 units that are 50% complete. So that's the equivalent of 50 completed units. So now we've got 250 equivalent units. So the cost per equivalent unit is $250 divided by 250 units. So that's $1 per unit. This means that the work in progress is worth 50 and the finished goods are worth $200, and that seems much more equitable. So we're going to use this concept then of equivalent units to value any work in progress that we have at the end of the period. In lecture example 4, we're going to work through for a company called Finish It, which doesn't manage to get all of its work in progress finished off before the end of the period. Now, you're not going to have to do all of these 5 steps and completion of the process account for one question, but as I've stated before, for one of the section A questions, you could have to do any component part, so you need to understand all of the process. So we've given some information about what goes into process 1, and we're given some information about the outputs. There were no losses because you're not going to have to deal with losses and work in progress in one question. So what we can assume then is that if we put in 1500 units and we've got WIP of 50, that we end up with good output to process 2 of 1450 units. So we start off then by filling in our flow of units. So we put in 1500 units. We've got closing work in progress of 50 units. So that means that our outputs to process 2 must have been 1450. In terms then of our valuation, those raw materials were worth $12,000, the labour costs were $8,880, and the overheads $2,930. The total inputs to the process then $23,810. That's just the total there. What we need to do then is, before we can value our output to process 2 and our closing work in progress, we need to do our statement of equivalent units so we can carve that 23,810 between the different types of units. And we're going to use this information about the percentages complete to help us. So we need to set up a table, and you've got the pro forma here in part B, for the statement of equivalent units. So the 1,450 units of finished output must have been entirely complete for materials, labour and overheads, because they were complete by the end of the period. The work in progress, though, was 100% complete for materials, but only 60% complete for labour. So 60% then of 50 is going to be the equivalent of 30 units. And for overheads, it was 30% complete. So 30% of 50 is 15. So that's the equivalent of 15 units. We need to keep separate columns then for materials, labour and overheads, because they're all different percentages complete. You might find it useful to just jot down the percentages to remind yourself where they came from, those numbers. So we've got the equivalent then of 1,500 units for materials, but only 1,480 for labour and 1,465 for overheads. Now we need to look at the input costs. So for raw materials, the input costs were $1,200. Divide that by the 1,500 units, and the cost per equivalent unit for materials is $8. For labour, we've got costs of 8,880 divided by 1,480. So that's going to be a cost per equivalent unit of $6. And finally, for overheads, we've got 2,930 divided by 1,465. So that's a cost per equivalent unit of $2. So the total cost per unit is $16 per equivalent unit. We use those costs per equivalent units for our valuations, and we need to value both the finished goods. So the finished goods then are valued at the $16 per unit, and we've got 1,450 units. So that's $23,200. For the value of closing work in progress then, we need to do each item separately. So we have, for materials, 50 units at $8 each. For labour, the equivalent of 30 units at $6 each. And for overheads, the equivalent of 15 units at $2 each. So that's a total value of closing work in progress of $610. We can take those now and use those values to complete our T account. So the closing work in progress was 610 and the finished goods 23,200. and check that that all adds back up to the 23,810. For Henley's then in example 5, we have a completed process account. There are no losses incurred and there's no work in progress, but we do have some closing work in progress at the end of the period. And we're being asked to work out then what percentage degree of completion was that closing work in progress. So we need to work backwards then to work out how complete it was. The starting point then has got to be working out the cost per equivalent unit. Instead of working out the cost per equivalent unit by going through the stages with the process percentage complete of the closing WIP, what we can do is we can have a look then at the valuation of the finished output and divide that by the number of units. So the cost per equivalent unit in the process was $35. We would have calculated that and used it to value the 7,000 units. For the closing work in progress then, we have $140,000, and if we divide that by the $35 per unit, that was 4,000 equivalent whole units. Actually though, that 140,000 represents 5,000 units. So 4,000 whole units divided by 5,000 partial units means that that work in progress must have been 80% complete, which is answer D. The final thing that we need to consider as a complication then is the treatment of opening work in progress, because last period's closing work in progress becomes next period's opening work in progress. We have two different ways then that we can treat opening work in progress. There are two assumptions that we can make. There's first of all Fifo, which assumes that the opening work in progress is completed first. So at the start of next period, you take something that you've already started and finish it off. The treatment that you will use here then is to spread the costs incurred over the work that's done in that period. So that will be the output that is completely started and finished in the period, the opening work in progress that's finished, and the closing work in progress that started. And then we'll add on to that the opening work in progress costs to give the total costs of finished output. And we'll see that shortly. But what we also need to consider is the alternative, which is the weighted average. The weighted average then is slightly simpler, and it assumes that everything is equally likely to be completed, regardless of whether it's already been started. So then we spread all of the costs, including those brought forward, over all of the units. And as I said, questions won't contain WIP and losses. But when we are doing our opening and closing work in progress, we do still need to remember our unit calculation. And our unit calculation is extended so that opening WIP plus the inputs has got to equal all of the output. The good output, the normal loss, any abnormal gains and losses, and also the closing work in progress. In worked example 6 then, we're going to use both Fifo and weighted average methods to prepare the process accounts when we have got opening and closing work in progress. We're going to use the subsequent period from the information that we had in lecture example 4. In the exam, if you are using a subsequent process, the information will be presented to you. So what we've got then is information about the inputs for the next period, and we've also got information about the outputs. So we've got good output of 2020 and some closing work in progress. The raw materials added are 2,050, and we have that opening work in progress of 50 units from lecture example 4. And what I've just done is I've jotted down the breakdown of that opening WIP of 50 units. So the percentages complete and also the values of it, because we'll need them in the question. Should be able to see straight away then that the output comes to 2,100 and the input also comes to 2,100. So our flow of units balances, and we'd expect that because we're told that there were no losses during the period. We've just got the flow of units calculation over the page. So starting off then looking at it from a FIFO point of view, we have then all of our inputs, which are the same as before, but we've just got this extra line here then for our opening work in progress. What we need to do then to work out our closing work in progress is to do our statement of equivalent units. The statement of equivalent units then is going to have this good output in the period of 2020, but it will be broken down. So it will be broken down into things that had already been started, the opening work in progress, and the units that were started and finished. So this figure here of 1,970 is the balancing figure, because it's the difference between the good output and the opening WIP that needed to be finished off. The opening work in progress was 100% complete for materials, so that meant that there was 0% to complete. With regards to labour then, it was 60% complete, so that meant that there was 40% to finish off. And for the overheads, it was 30% complete at the start of the period, so there was 70% to finish off. The number of units started and finished will be identical, because if they were started and finished, all of the stuff must have been done. Then we've got the closing work in progress, which we've started. It was 100% complete in terms of material, and the question informed us that it was 60% complete for labour and overhead. So that's the equivalent of 48 units. So we need to add the output and the closing work in progress to give us our equivalent units. To work out our cost per equivalent unit then, we're going to take the costs in the process account and divide those by the number of equivalent units. So in the case of materials, 222,550 divided by 2,050 units gives a cost per equivalent unit of $11. And for labour and overheads, we'll take these costs from the process accounts and divide them by the number of units to give us $8 for labour and $4 for overheads. So the total cost for a good equivalent unit of output is $23. When we do our valuations then, we're going to have for our good output the costs brought forward in opening work in progress, and then we're going to have our equivalent number of units multiplied by the cost per unit, and that's the equivalent number of units of output. So for materials, that's just going to be the units that were started and finished. But for labour and overheads, it will take into consideration the items that we had to finish from opening work in progress. And the closing work in progress, we're just going to value in the same way as we did when there was an opening work in progress, looking at the cost per equivalent unit times by the number of equivalent units of closing work in progress. We can take these two figures then and pop them back into our final account. So we've got 1,456 closing work in progress and 46,220 for the valuation of goods transferred to the process 2. The important things to remember are the breakdown between output in terms of what's to be finished off and what is started and finished during the period. And when we're looking at valuing our good output, it's based upon the number of equivalent units that were done during the period and transferred as output to process 2. You might want to pause the recording now before you start to look at weighted average and get FIFO straight in your head. But what we're going to see now is to have a look at the weighted average approach. So the flow of units then are going to be the same under FIFO and weighted average. But what we need to look at then is how we value the transfers to process 2 and the closing work in progress. We start off with a statement of equivalent units. The statement of equivalent units under weighted average is the same as when there was no opening work in progress, because we say that everything is equally likely to be finished, so we just need to consider the percentages for the closing work in progress. So in this case it was the labour and the overheads that were only 60% complete. The difference arises then when we're doing our cost per equivalent unit, because we have the breakdown of the $610 for opening work in progress. So because we've said that all units are equally likely to be completed, we have to add in the cost brought forward in opening WIP when we're working out the cost per equivalent unit. So when we're doing the cost per equivalent unit for materials, we're taking the 22,950, the costs brought forward and those incurred, and dividing those by the 2,100 units, and that gives us our 1093. When we do our valuations then, the good output is just the cost per equivalent unit multiplied by all of those units that were finished off. We don't need to worry about whether or not they were started and finished or any costs brought forward, because we've already included all of those. And then we value our closing WIP by looking at the equivalent number of units by the cost per unit. And we take those figures and pop them back into our T account. So 46,238 for good output and 1,448 for closing work in progress. What you will notice though is that if you cast the debit side and the credit side of your T account, you end up with a difference of $10. When we use weighted average, we round to the nearest cent, and so we end up with a slight rounding difference. It's one of the only occasions where you'll ever get away with putting a rounding in your T account if it doesn't balance. So how will we know whether to use the FIFO or weighted average in the question? Well, it doesn't always state the method to use, and as you can see the answers are different, so it does matter which one you choose. The best way then to make the decision to remember which one to use is by looking at how the opening work in progress is quoted. If it gives you the percentage complete, then you need to use the FIFO method, because you need those percentages to work out the percentage that you have to finish off in the period. If, however, it gives you your total costs broken down for opening work in progress in dollars, then you use the weighted average method, because you'll be bringing those costs brought forward into your cost per equivalent unit. Lecture example 6 gives us an idea then of how this could be tested in the exam. So we've got a company then that had work in progress at the start of last month of 750 units. So 750 units, and we are told that it was 60% complete in respect of all costs. Given the fact then that we are told that it's 60% complete, hopefully you're thinking FIFO, and this is confirmed for us down here where it says the company uses the FIFO method for cost allocation. 5,000 units were complete and transferred to finished goods, and the cost per equivalent unit has already been calculated at $15. We don't have to worry about the different types of costs, materials and conversion, because the percentage complete is the same for all of the units. But what we have to do is work out the value of those 5,000 units that have been transferred into the finished goods warehouse. So we're going to need to do some calculations. We're not told that there was any closing work in progress, and so what we assume is that we have got 4,250 units which must have been started and finished in the period. So 4,250 units started and finished in the period at $15 each. So that's $63,750. We also have those 750 units of closing work in progress. Now they were 60% complete at the start of the period, so there must have been the equivalent of 40% to finish off. So that's 300 units still to be finished off, and they will also be valued at the $15, the cost per equivalent unit. That's 4,500. And we need to add to that the value of the opening work in progress that we had at the start of the period of 6,375. Because we've included the costs of finishing them off, but we hadn't included the costs of getting them to that point in the first place. So that's going to give us 74,625, which is answer B. Hopefully lecture example 6 then is very useful at showing you just how happy you have to be with worked example 6, because you could be required to complete any of the stages. The question could equally have given you some additional information and asked you to work out the cost per equivalent unit. If we've got output from a previous process which undergoes further processing in a subsequent process, we may well have an additional line. So opening work in progress, materials from process 1, added materials and added conversion costs. By definition, it has to be 100% complete in terms of process 1 inputs, the materials from process 1, before the process can start. And if that sounds a little bit confusing, I think the easiest way to think of it is to think about process 1 being baking cakes and process 2 being icing cakes. You won't be able to ice a cake that isn't finished, it hasn't been baked, in process 1. So it has to be completely complete in process 1 before it can be transferred to process 2. So even if it doesn't state that it's 100% complete, you can make that assumption. This chapter has enabled us to look at how to cost processes which produce products which are not separately identifiable until the point of separation. So when we don't have separate units, we use process costing. And there's terminology then to be aware of. So expected losses are called normal losses, and losses that were unexpected are abnormal gains or losses. Subsequent processes then are when we're using things from one process to become the inputs to the next process. Separately to dealing with losses then, we need to think about work in progress. So we need to think about accounting for things that have not been completed. If we've got opening work in progress, we can use either Fifo or weighted average to value it. If we've got closing work in progress only, it doesn't matter which one we use. The approach then to these questions will be to determine the output, the losses and the work in progress using the flow of units. Then we set up our process account and fill in the easy numbers. for example, the flow of units and the value of any normal losses, calculate the cost per equivalent unit, and complete the accounts when we've done the valuations. How do we know which one to use? Well, if opening work in progress is given as a percentage, use FIFO, and if it's given as a value, a monetary value, use weighted average. As well as thinking about future or subsequent processes, we also needed to consider previous processes. So that's when the output from one process goes into a next process. It has to be complete before it can be processed further.